U.S. congressional leaders are racing to push through a compromise sealed with President Barack Obama overnight. That's proposed to raise the U.S. debt limit by at least $2.1 trillion and also slash government spending by about $2.4 trillion or even more. Joining us now to discuss these developments and how America actually got to this point is Jean-Francois Mercier, Chief Economist at Citi South Africa, and also Frank Blackmore, Senior Economist at KPMG. Gentlemen, thanks for your time. So it's a last-minute deal, Jean-Francois, but the deal prevents default. It doesn't necessarily mean there won't be a downgrade in America. What does that mean?
Well, we were never talking about a country that does not have the means to pay its obligations, nor really doesn't have the will of paying its obligations. Generally, a country defaults either when it cannot pay, as in the case, say, of Zimbabwe or Swaziland, or when it doesn't want to pay. Say the case of the Soviets after the 1917 revolution. In that case, it was a case of politicians not being able to agree on how to pay. And it would have been a little bit silly, really. It wouldn't have made really sense for an economy, for a country which has depth in its finances, depth in its tax base, not to honor its obligation. But of course, the problem of high deficits and rising debt remains very present.
Is there an imminent downgrade, and what does that mean for America?
Well, it could be. And the major issue that is impacting that would be, are the cuts proposed to their spending enough to reassure the markets that default won't take place, technical or other, even given now the increase in the debt ceiling. So I also think that maybe the effects of that wouldn't be as severe as what some might assume. You price these things in. If there's a 10% of US defaulting, we would already, most markets would take these into account. But obviously for the US, it wouldn't help their story because now you have to borrow at an obviously higher rate.
Right. I mean, as Jean-Francois was saying, this was never a country that wasn't able to pay. The worst that could have happened, we're told, is that they would have rolled over their debt servicing and coupon payments to a later date until they could get some kind of deal, and if not a deal, some kind of good rate from commercial banks. But what does that tell us about the state of the US economy?
Well, the thing that bugged me in this whole issue was the political debate surrounding it. I think there was always much ado about nothing here. A lot of the world couldn't afford a US default, technical or other. And so we were always going to increase the debt ceiling. But the debate hinged around how much, when, how soon to move that can a bit further down the road. And the problem still remains. We still lack growth. And I think that's the underlying issue here. As soon as things grow, we are able to repay our debts, or the US would be able to repay its debt. Whether it would want to at that point would be another situation, because then the economic landscape would be much more positive.
What does this mean, debt and deficit? Because those are the two issues that have come to the fore. Raise the debt ceiling above $14 trillion US, but spending cuts to be reduced. Doesn't sound like dovetails to me.
Well, it sounds a bit like a contradiction, because normally if you reduce deficits, you don't have the debt. But the thing is, if you did not reduce the deficit, you would have needed to raise the debt, not only raise the debt ceiling, but you would have seen a very important rise in the debt as a share of GDP. If you use the benchmark of debt as a share of GDP from about, say, 90% growth right now, maybe we would have been on 140, 150% in 10, 15 years, and that is really what the deficit reduction package aims at achieving. Gradually reducing the deficit against the baseline scenario, which would see it increasing, because the problem with the US is that they are now hitting the retirement age of baby boomers. The number of pensioners related to the number of active tax-paying people is growing, and therefore the social security entitlements, the healthcare entitlements under Medicare would grow over time. Hence the package to not necessarily reduce the debt ratios, but at least preventing it from rising to levels which would have been threatening in the long run, and definitely would have led to repeated downgrades of the rating.
What are the consequences, one, for the US dollar, which we've already seen weaker in recent weeks, and Treasury bills? Because certainly I wouldn't assume that many investors would want to be taking on US debt?
Well, if you look at what has happened over the last 10 years, interestingly, you have seen the dollar weakening generally, with a few exceptions over these 10 years, as investors gradually have moved away already from holding too many dollars. This has explained in part why gold is so high, why many commodity prices are so high, because they're traditionally denominated in dollars. But at the same time, the treasury bonds, treasury bills have not seen much of a rise in their yields. So there's been a bit of a decoupling between the dollar as a currency and government securities that are denominated in dollars. Now, what happens, for instance, if you have a downgrade of US debt? You would expect that normally that translates into maybe 20, 30, up to 50 basis points in higher US yields. Which is manageable. You do see that in most cycles. But if it is something that is permanent over a cycle, as normally it would be if it's a credit problem, the US potentially would end up paying more to finance its economy. And many other countries which are dependent on the dollar would also.
Effectively, borrowing costs should be rising in the United States, and what we've seen in the past is that investors who are a bit skeptical piled out of dollar-denominated assets looking for yields in emerging markets. But global markets have been subdued, so that theory doesn't seem to hold right now.
I think there are many ways of looking at this problem. So even the decisions that took place today, on the one hand you have the avoidance of default, which is a positive thing. On the other hand, you have cutting government expenditure, which will affect growth within the short to medium term as well, which is a negative thing. Then you also have the relative situation. How does the US economy stand up relative to Europe or any other region in the world? And so it's not always simple to see where currency would flight to, and therefore you can get these contradictory indicators happening on global markets.
Going forward in America, we've been told, or it's been reported, that we could see another cycle of quantitative easing as authorities try to stabilize the financial system. The wisdom of doing that?
Yes, they're talking about QE3. Even Cunard has not gone that far, because they've got Queen Mary II, Queen Elizabeth II, but they're not yet at Queen Elizabeth III. The thing is, you got to ask, is it really going to make a difference? Isn't the Fed going to run the risk of being too loose for too long? And isn't it a bit of a problem of trying to push on the proverbial piece of string? If the problem is that there's a lack of confidence in the US economy and that businesses do not really want to invest, which was changing actually a little bit, or households do not want to buy new houses, is it going to make a very big difference that you try and push down interest rates further by having the Fed buying government bonds? Maybe at the margin, but the issue there for the Fed is to try and weigh what are the risks of yet another round of highly unconventional monetary policy against its benefits, which in the case of QE2, you can always already debate, did it make much of a difference?
Can I be really rude at this stage? Some people looking at the situation right now say, here's a country that's highly indebted. Here's a central bank that needs to come in and shore up its government securities. Here's a country with rising unemployment rates. Here's a country that runs the risk of inflation. Actually, you know what? America's a bit of a rubbish economy, and credit ratings agencies should just call it what it is.
And I think that's the way a lot of people would see the issues on the table, because most of them are not positive issues. But what people forget is still the largest market in the world. They still produce a lot of goods and services. They're intertwined in the global economy more than any other economy out there. And their importance on the global stage is still primary number one. There's been a lot of focus on the East and the emergence of China and emerging Asia. But the current guy in the top position is still the US. And we mustn't forget that their importance in the global market is still, without doubt, confirmed. So,
what does this tell you about credit ratings agencies, and not just in the United States, beyond that? Credit ratings agencies, they always seem to speak after the fact. Once Greece is faced with a crisis, now they start to say, oh yeah, actually they've got serious debt issues and we're going to downgrade. Now that America's in this position, they're talking about downgrading. If they're sitting with the information at hand, surely they should be able to anticipate and help these leaders see that actually they're walking on the wrong path and prevent them from getting to this point?
Well, that is a debate that was already raised at the time of the subprime crisis. You know, why did the rating agencies, in the case of this subprime debt or different types of mortgage debt, not warn in advance? You know, now part of it is, of course, the issue that a rating agency is not an independent observer whose judgment is completely, how I would say, completely ineffective on what happens in the market. You know, if a rating agency tries to anticipate a lot, it might end up by scaring investors away, provoking a crisis that would not have taken place otherwise. You know, so even if maybe an economist from a bank can say, "Oh, I don't like that debt. You know, that's going up. I don't like it." For a rating agency, whose decision is watched by a large number of investors, they have to think twice. But sometimes you have to make a decision and you have to say things as they are.
If there is a downgrade of the United States following all of this, will investors react to that on the basis of some of the weaknesses and limitations of these ratings agencies?
No, I don't. I think the credibility of rating agencies took a big knock, as Jean-Francois was saying, when the crisis kicked in. And I think a lot more, you know, what happens is you have buyers and sellers in the market of financial products. And obviously the sellers have to pay the rating agency to give them the rating, hence the conflict of interest. The buyers then also, one would say, has to believe that rating. I think that belief is not there anymore, and you're seeing a lot more fund managers, banks, etc., starting to create their own proprietary research organizations in-house to have the agency view, but also have an in-house view on things. You can't trust someone else for the ratings of your investments.